Bob, aside from being the head market strategist at BNY, you have a very long and strong foreign exchange background. So what is the dollar and its strength or lack thereof telling you right now?
Look, the dollar is the shock absorber between the economy and the asset markets. And it goes up and it goes down. Right now it's going down. It's going down for a number of reasons. Are those reasons going to lead to a longer term trend? Perhaps, but I don't think there are a lot of alternatives to the world's reserve currency. We're the only place where you can put $40 trillion of bonds or $70 trillion of private equity and other markets and feel safe. So long term, still a dollar bull. Short term, not so much.
Well, it seems like people are trying to find other places. If you look at gold and Bitcoin, what are those two asset classes telling you?
So private money and gold as a fiat alternative. Look, I think it just tells you that the world is concerned about having too much debt. The world is concerned about central banks being caught in a very difficult place between some countries have stagflation, some countries have no growth, and rate policies aren't really solving those problems.
So let's talk about countries with too much debt. How closely are you watching the budget battles in Washington, D.C.? How are those factoring into your thinking?
So look, we see in our data, we are the world's largest custodian and have $53 trillion of money flowing through our pipes. And the number one question from April was, oh my gosh, who's selling U.S. debt? Well, it was a combination. And at the end of the month, we actually saw buyers. What did we learn from that? We saw that investors like to get paid for their risk. So there is a term risk premium and a equilibrium level. It's probably around where we are, 4.5 and 10 year looks about right. Could it go higher? Well, it depends on what happens in Washington and how credible this tax bill really does matter over the medium term. In the short term, we're also concerned about growth and whether the Fed is going to see fiscal stimulus or fiscal restraint. So there's a lot of things in play here for the bond market and the debt.
So heading into the summer, what is your outlook? Will they get this budget deal done, and how will that impact allocators like yourself?
So asset allocation is a slow-moving train wreck of things that are pretty much out of portfolio managers' control. Sometimes that term premium doesn't make any sense, and yet you have pressures to own more bonds. The pressure at the beginning of the year, we were closer to 70-30 in overall portfolios of active managers, and now it's closer to 60-40. But if we're going into a recession, maybe it should be 50-50. And if we're not going into a recession, maybe it should be 65-35. So there are a lot of decisions that happen over the quiet summer, which probably isn't going to be very quiet. I think that we're in a place where if you get paid for your risk, you're going to see positive flows into bonds. And that's probably pretty close to where we are, or a little bit higher in yield.
Also, speaking of asset allocation, a lot of allocators like yourself are putting more money into places like Europe. So can you talk about international investing, even emerging markets, which have done very well year to date?
So we saw a big surge of interest into Europe actually before April 2nd, which was really linked to the German election, the surprise idea that they can increase their spending there. And we've seen since April 2nd, much more willingness to see bonds as a valuable counterpoint to maybe U.S. Treasuries, in part because of the debt downgrade, but unlikely. What really is going on is that global rates are getting to levels where it becomes more important to have them in your portfolio other than stocks, which have been true for 10 years. JGBs being an example of that. JGB yields are more attractive than bonds. So we're seeing flows out of U.S. into Europe and, Germany in particular, but also Japan. Overall, this is about getting paid for your risk.
And then finally, you do have that foreign exchange background. And in recent years, we've seen people heading over to Japan with the yen at 150, going over to Europe. Lots of people going to Spain and Portugal in recent years like you've never seen before. So is this a good time for folks? The last time they're going to be able to go to Japan or Europe? Because are we going to see that yen at 130, 125, strengthening euro because of our fiscal mismanagement over here?
I've been going to Japan for a long time. Japan at 90 yen is expensive. Japan at 125, it's kind of like New York. Japan at 140 or 150 is cheap. So I do believe that over time we're going to get to fair value. Is this the summer of the dollar's discontent? Perhaps. I think the euro at 120 and dollar yen at 135 at the end of the year makes sense. I don't think that makes them expensive. I just think that it becomes more in the realm of fair value. In terms of emerging markets, which I didn't answer your question, do I like emerging markets? Yes. Why? Because they offer an alternative to this idea of, well, Japan has its problems, Europe has, unification problems. Are they going to get a common budget? Are they going to get all these banking deals passed? Who knows? But emerging markets offer that clear carry that, Brazil or Egypt, where we see a lot of flow, offer, a tail, which you can't put all your money into that portfolio, but 20% is an attractive yield in real terms.
All right. Well, thanks for coming on and talking about it.